So we're going to have opportunity for a few questions, for about 15 minutes of questions, and then we'll have a little networking session outside in the patio area there. So look forward to that. So if we have two sets of mics on both sides of the aisles. If you have a question, please walk up to one of the mics and ask a question.
Dr. Scholes, a question. What do you think is the major lesson learned from the collapse of long-term capital? And do you think that lesson that was learned applied to the financial crisis of 2007, 2008?
I gave all those lessons in 2000 and in 1999 and 2001. But, you know, it's interesting. When I taught students, you know, I thought it was terrific. They were understanding everything I was telling them. But I think you really have to experience something to understand it. So there's no sense in saying what the lessons are. You've experienced it. The idea is that, you know, in a very simple sense, that, you know, you can't risk and is a very important component of what you do. And if you take too much risk, then basically you have to adjust, especially leverage. Leverage is the key thing. Leverage is like a cancer in a lot of ways. You know, it doesn't, if you owe money and the value of your assets fall, then it's necessary to do something. It doesn't disappear on its own unless you build a system which has, you know, dynamic or adjustable debt. So the levels of risk you can take and how to run a levered economy and is very crucial. And you know, in a lot of ways, the fallacies of credit have hurt us dramatically for centuries and continue to do it now. I mean, the three fallacies you got to always worry about is that, and governments are doing it now, and people are saying if someone is owed money, you got to lend them more money. Because if you don't lend them more money, like Germany lending money to the periphery, then they'll go broke, and you'll never get your money back. But basically, it's an out-of-the-money option. You know, it probably won't come back, you know. So it's throwing bad money after good. And the second fallacy of credit is that when people have entitlements, you know, even though we didn't fund them or didn't pay for them, that they earned them. You know, so you see in our country the same thing. There's a lot of debt, and no one paid for these. Someone's got to pay for it. You know, and that's the second issue. And the third fallacy of credit is that if I create exports, somehow my country is going to be better off. But you can export a lot, but if you give people credit to buy your goods and services and they never pay you back, you know, it's not necessarily a good trade. So I think the issue really fundamentally is how to handle debt and, you know, and understand the volatility and what it really means.
But you did encourage us to borrow from Japan.
Pardon me?
You did encourage us to borrow from Japanese banks.
Well, they're never going to ask you for your money back. So that's the best part of it.
Our next question, please.
Doctors Sufi and Scholes, and may I say good evening to you, Dennis Navarre, class of 1978. Privileged to be in the community of two gentlemen, a current and a future economic Nobel Prize winner.
Good.
My primary question is for Dr. Sufi, and it's the question why. Why were the 600 credit scorers able to borrow so much? As my former professor, Uncle Milty, used to say, you can't fool mother supply and demand. Yeah. However, can't you with government intervention? So why were those 600 credit score people able to borrow so much and do such devastation? One, was it primarily because of excessive government intervention, Freddie Mae, Fannie Mae, stealth quantitative easing, Clinton and Bush administration policies, et cetera? Was it two, a quantum shift in banking ethics and business practices? Three, all of the above? Four, none of the above. Thank you.
I would say three, all of the above. So let me kind of give you my basic sense of it. So this is if you look at the microdata, it's as clear as the blue sky that something very strange was happening in credit markets from 2002 to 2006. It's the only time that you can ever look at microdata and actually see a negative correlation between credit growth and income growth. Just think through that for a second. You know, you walk into a bank, usually a bank is going to lend you more if you have higher income. But from 2002 to 2006, at the zip code level, zip codes that were having declining income performance were getting more credit. Now, the question is, how much was it government policy versus things that went into the private sector? I think it's a toxic mix of all of it. And I think that my fundamental story, let me try to be quick in my narrative. My narrative is 1998, financial crisis happens, IMF comes in, imposes very strong constraints on South Korea and a lot of the other East Asian countries. They say to themselves, we're never getting in this mess again, which is related to what Myron was saying about them wanting to set up their own IMF now. And if you look at the literature, it's quite dramatic how harsh the conditions that the IMF placed on very solvent economies like South Korea. What did they start doing? They started stockpiling US assets like crazy. Okay, though that's something that Myron pointed out as well. That credit finds its way into the United States. This search for AAA-rated assets that will be safe, that reserve banks in China, South Korea, all the East Asian economies. And also there's an issue going on within the US, wealth inequality is going up, maybe there's a demand for AAA assets. At some point, this idea of mortgage securitization happens, right? That we can actually create very super safe assets out of very risky underlying assets. And there's a specific element about the correlation of defaults that I think was misunderstood in a real way by bankers and the people buying these securities. I don't think it was blatant fraud, although there was a lot of fraud going on, don't get me wrong, but I don't think that you can get this kind of boom with fraud alone. Then Freddie Mac and Fannie Mae kind of want to get to the party, and they kind of come in later in 2005 and 2006. And so I think this narrative that Freddie Mac and Fannie Mae are responsible for the whole thing is a bit misguided. Now, I think it is credible to say that Freddie Mac and Fannie Mae stepped in to the party when maybe it would have ended and like had it go way past midnight. You know, we all know nothing good happens after midnight at a party. So, you know, I think you can make that kind of compelling argument. But at the end of the day, it's amazing how, even in a very different context, I would say I fully agree with what Myron was saying. At the end of the day, a lot of this is about debt and what debt does to us in terms of not making us realize what exactly risks we're taking on. And it's amazing how many episodes in world history are preceded by people being sure that they're holding something very safe when they're lending aggressively into a bubble. So Charles Kindleberger is known for writing this, and the quotes from his book are amazing if you read them. He didn't even live through the entire episode of what we just went through. And he says every single financial crisis is preceded by people being sure that they're holding something as safe as money. And so it's this kind of general phenomenon that you see in every single financial crisis that makes me believe that it's something fundamentally related to the way debt makes us feel safe if we're the owners of it. Not if we're the borrowers, but if we're the owners of it.
If he were still an MIT professor, he would have just said C. You're learning. Next question, please.
Hi, thank you for speaking, appreciate it. This question's for both of you. Wanted to sort of bring up a little controversial thing. With regard to the Reinhardt-Rogoff controversy, their paper versus, and also the UMass sort of correction of the statistics, it seems like the trend line was still the same, that if you have higher debt to GDP, that growth rates were lower. Could you speak a little bit from your perspective on your views on that, and with regard to austerity versus spending, knowing that even during good times that we don't cut back, but just wanted to leave that in your hands and see what you guys thought about that.
Actually, yeah, it was unfortunate that they had the error, and you know, there's always the question of how the debt within a country was built up. Was it built up first? And I mean, there's an interesting article if you want to read it today in the Financial Times by Martin Wolf, which I thought was a pretty good article, which summarizes things. You know, and it's interesting. It's an interesting problem. I think I tried to bring it up before, but you have debt is a stock and GDP is a flow. And we really don't have any good models as to what it is that is going to create this relation between debt and GDP. Now, you could have a situation where GDP is lower and debt increases because the government had made promises if you make promises that are not funded, then you have to borrow money if you're not going to increase taxes to pay for the services you're going to provide. So it's a chicken and egg problem, you know, and the really interesting issue is obviously you know, in the logical sense, like the Laffer curve, you know, if you tax people 100%, they're going to be on the beach, you know, and they're going to tax them a lot, they're going to do things on their own, but we're not going to have any government services. So we have to do it all for ourselves. So it's, you know, I think that it's true that levels of government debt are the same. You know, Milton Friedman's talked about this in the past, that it's really the expenditures that the government undertakes that is the key, not how it's financed. But it seems that politicians find it easier to use debt to fund than they do to use taxes. But I'm not exactly sure. I agree with the statistics, but they're not as dire as the Rogoff-Reinhardt papers initially said. In fact, the spread is not very great, and it's true, as you said, but we don't know what causes the debt. Is it a chicken and egg problem? And 3, is it really statistically significant? You know, we know countries default, but Japan has 200% debt to GDP. It's 100% contained in the economy in its own country, or 99%. And you know, we'll see what happens in the future. So I read the work, and I thought it was very good work. You know, Rogoff-Reinhardt was very good, but I really never got really excited about these debt to GDP ratios.
Yeah, I think, let me just add one thing. I think if you read This Time is Different and you look at the actual agenda that you know, Carmen and Ken established, it was more about the dangerous rise of private debt burdens in the household and banking sector leading to financial crises. And that research has been shown over and over in different contexts by different authors. It's extremely compelling. The public debt to GDP figure was published in the AER in the May edition, which is not even peer-reviewed. And it was kind of a throwaway correlation in my view. I don't think any economist, I didn't think at least, I didn't take it that seriously. We don't even know which way the causation goes, right? You can easily see a country struggling first and then having high GDP. So I think people, you see this debate is so ideological that it's very hard to get at what the facts are. And it's unfortunate that this public debt to GDP has been latched on by different people, even though it's not that robust of a finding, and it's not something that I think academics I mean, it's funny, a lot of us were talking about this at the NBR last meeting, and it was funny because we were saying whatever the data mistake, even if the data were perfect, none of us would believe the causation at all. I mean, we just, you know, so if you're high debt to GDP, you could easily get high debt to GDP because your economy's suffering, right? So then it looks like high debt to GDP causes suffering, but we don't know which way the causation goes. So the whole episode's a bit sad to me. I mean, you know, because I think their research on the private debt burden, their research in the book is phenomenal, and it's really excellent research, and there's important lessons. And to be frank, on the austerity question more broadly, I think it's a very hard question. I wish we knew better, but I think Myron kind of outlined the general way we think about it, but the empirical evidence, I think, isn't so strong either way.
I mean, in history, I mean, austerity is never, I mean, the best way to get out of your troubles is if you can inflate, which is, you know, and devalue your currency. I mean, that's the age-old way in which it's worked. Sweden got out of their problem, but they're a small country, and in '92 they were broke, you know, and they recovered very quickly. And the main problem is how fast you do it. If you do it quickly, and you can have wage adjustment. It's very hard to have wage adjustments. It's very hard to have rental rate adjustments, and it's easier to let everyone suffer the pain through having, you know, inflation or depreciation of the currency. And as we know what's happening in Greece or Spain or other countries that are in austerity programs, they're trying to force wages down and trying to force rental rates down so their businesses can become more competitive. So it takes a very long time for that to work its way down into the system. That's a lot of ways why we abandoned gold standards many years ago, because it's only adjustment you have is through wages and through rental rates on property. That's a very tough thing to impose on, because it's very tough when you have unions and others who restrict that type of activity. Or even the population will riot when they have to take lower wages or be unemployed.
We probably have time for one more question, and there will be some time for all of us to network in the back room after this. So one more question.
Hi, this is a prospective student. I think my question is kind of touched upon, but I would be appreciated if you could shed more light on it. So, Dr. Shaw, we talked about that GDP is not a good indicator for measuring the wealth of society. And I would want to know, what kind of parameters or indicators would you suggest or come out with? Is it, for example, like the aggregated measurement of people's quality of life? Or is it could be GDP with adjustment of public debt or some kind of, what kind of parameters would you suggest to measure the social wealth?
I can start, but basically, just quickly, that's why we use GDP. It's very hard to measure what we should be measuring. It's sort of the really interesting question that we all have to ask. GDP works when Kuznets and others defined how to do it. The gross domestic product. Being, consumption, investment, and government expenditures, it was all underlying that model was the belief that each of the sectors was actually taking positive net present value projects. So our society really has to ask the question, is it the case that the government is taking positive present value projects? And what the requisite discount rate is, or are they just spending money that is not? And that's what the debates we're trying to have, and that's what they should be always focused on. It's very hard to measure the value of human capital, but basically if we are in our society, I don't want to end up in a situation where we're trading off the old versus the young, and trying to preserve all the benefits to the old, which at the same time we tend to be robbing the young. And so the question is to what role we should allow the private sector to be involved in, and what services and role the government sector should be involved in, and how their activities impede growth of human capital and impede growth or foster growth of physical capital. But if we think about our wealth as the criteria, however we define it, and focus on that as opposed to in the short run trying to get the GDP of the economy up, I think we have a better discussion, a better way to discuss the issues than concentrating on a flow variable, which is like looking at the dividends of a stock. Everyone's saying, oh, Apple should pay a big dividend, it's going to make great things, but really the question is not paying the dividend, it's what's Apple going to invest the money in versus paying the dividend, or what it can be better in the hands of stockholders. And the market had a big debate. For a while, they said it's going to go up. That's a good GDP for Apple, paying the dividend. Or, on the other hand, the markets didn't like it because Apple didn't have as good investment opportunity. So that's the issue in my mind, is really asking the more fundamental question, are we adding value for our human capital? Are we adding value for our physical capital?
So with that, maybe what I'll ask both of you to do real quickly is part of what has traditionally been done in the forecast is actually give a forecast of where we think things are going to go. So, and that's why it's been called Outlook instead of the forecast. But I would like to hear if you have any departing thoughts for us as far as other outlooks on at least what the growth of the...
So I did one of these things for our booth alums CFOs, so I did a little bit more specific numbers. So I think consensus forecast for GDP is something like 2.9%, 3%. There's some bad numbers that have come out in the last week. I don't know, my personality is generally to be sobering, so I'm a little bit more pessimistic. I think the sequestration issue is problematic. I think Europe is really scaring me. I have no idea what's going to end up coming out of Europe in the next 6 months. So I'll say 2.2%, quite a bit lower than consensus in terms of GDP growth for the U.S. I'm on record now. There's cameras. So 2.2% GDP growth for the U.S. for 2013.
That's great. Dr. Scholes, any predictions?
Well, since I don't like GDP.
Human wealth will move to. Yeah, I agree that, I think China will slow down,
go from maybe to 7% growth rate, because I think they want it to be quality of growth as opposed to growth. And I think there's a trade-off there. So you're going to have trying to restructure the economy more and think about the quality and not just the quantity or the speed, okay, of growing the economy, which means that you're going to have a reduction in demand and slow down there in relative terms, which tends to cause the rest of the world to worry a lot. And Europe, I think, is really dead in the water for a lot of years, and that there's not going to be any growth. It's kind of strange. They keep in Europe giving us the average of the various countries, and Germany's slowing down. Japan is going to be really competing with Germany because Japan is going to sell cars now, and the German cars that you love and been bought with the euro being strong is not going to create growth in Europe. And basically, the Europeans want stability. They don't want growth. They want everything to work itself out. They want no riots, everything to look calm. And so therefore, I think there's not going to be, the euro's not going to depreciate. It's going to fluctuate around the 130 level. It means that the growth in Europe through exports is not going to be there. That means that who's going to buy our goods and services from the United States is not, exports are not going to be great. And I really think in the United States we're going to slow down for the rest of the year. I really think that no one really knows, how it's the case to create growth, and we're continuing to get this huge structural substitution, which we have to work our way through. So, in terms of nominally, do you want real growth or do you want nominal growth? We've had since this huge stimulus packages, I think we've had real growth of about 0.6% a year, even though nominally we've been at 2.5% or 3%. But as your chart showed earlier, there's not going to be recovery to normal things. We're not going to get any great growth. So I think that things will drag for the rest of the year.
Well, thank you both. I'd like to encourage all of us to just thank them again for